Welcome back. We're here with Ben Gossack, Portfolio Manager at TD Asset Management, taking a really close look at banks. We've been talking about lots of earnings, but now we're going to focus on that. And you know, I love accountability, and I love the fact you're holding yourself accountable to some of the things you talked about in the past. And we have a chart here of catalysts that Ben thought were important in taking a look at financials. And so we've got that here. We've got the things you talked about in March that were important, or the things that were important, what your call was in March and August and today. So let's bring that up to talk about it. Rising interest rates, corporate tax reform, regulatory reform, return of capital, and technology. So of those, where are we now on all those, and what matters?
Right. So U.S. banks has been a thesis that we like, and it's a multi-year opportunity that we see. It's not like a 1 or 2 quarter thing. If we go through sort of our checklist here, now that we're done earnings, and earnings were really strong, the focus is now on return of capital. So every year, the banks go through an annual stress test, and depending on how they do on that test, we'll then decide on how much they can return capital to shareholders, and that will be in the form of share repurchases and dividend increases. Yep. So we had really good returns last year. Almost 8% of market caps were returned to shareholders.
Wow.
And so right now, we're looking at 2018. It looks to be a little bit of a tougher test. So unemployment is looking really good in the U.S. And so the assumption is the same assumption last year, which is in the adverse scenario, we're going to go back to 10%. So it's a little bit tougher for banks. We still think that the payout ratio, so how much of their net income they can return, will be almost 100% for the U.S. banks. So we think it's positive, and we think it will be even better in 2019.
It's interesting with this, because all these things you talked about, they are happening. The timing may have shifted a little bit with a couple of them, but again, these are things that you highlighted and they've come to fruition more or less.
Right. So, I mean, tax reform was something maybe last year at this time we didn't think would happen. Happened in December. We're getting the benefit. Some people were disappointed that they didn't see an increase of loan demand from customers, but you have to remember, customers also had their taxes lowered to repatriate cash. So we think in the back half of the year, 2019, we'll see the increase in loan demand.
So that's the catalyst for U.S. banks. Let's talk a bit about, actually, just very quickly, any names that you like in the U.S. Space?
Yes, so we really like the large cap banks, and a lot of that is because they can take the most advantage of technology. So that's your JP Morgans, your Bank of America, your PNC.
Okay. Let's talk a bit about the Canadian banks, and I've got about 2 minutes here, and I want to make sure this is pretty important. We've got a chart here showing the stock performance of the big six big banks, or big 5+1, I'll put it that way, banks here in Canada. If we can bring that up. And what's interesting, and again, these earnings are coming out, I know soon. Why did you want us to show this? I mean, what's interesting about this?
So a lot of people own banks. It's another sector that we like in Canada. They came out really strong in the year, again, on really good fundamental earnings, but because of new rules in the mortgage market, it's brought, I would say we're almost at peak negative sentiment for the banks. So if you own a bank stock, you're probably down 2.5% for the year. But I brought another chart to actually look at the real data. So right now people are worried about housing and the fact that the stress test got harder and people's purchasing power got smaller.
So the concern is, again, that the concern about the amount of residential mortgages on banks' books.
If you have a friend who's a real estate agent or broker, they're probably like, nothing's happening.
Yeah.
And so this is actual industry data from the Bank of Canada.
And what is this showing?
Right. So we're looking at the balances on the bank's balance sheets of their residential mortgages. That's the red line. And we're comparing that to a year ago last year. So all of last year, we've pretty robust housing market. We're growing our residential mortgages at a rate of 6%. And so for all this talk that we've slowed down, we've just gone from a 6% growth rate to a 5% growth rate.
And to be clear here, just so people may not see the access, but this is going from 2013 to 2018. So this is showing you long-term what's going on.
So, I mean, if anything, we've bounced between 4 and 6%. Yeah. We're at 5, and we're actually at the level where management from the banks are guiding us where they think mortgage rates would grow for the year. Yeah. And we're at the worst possible time because we pulled forward a lot of activity into December because people wanted to lock in their mortgages. And at the same time, if you look at commercial activity, again, Canadian economy is up 3%. We got that report last week. And businesses, again, are demanding loans. That helps to grow the average earning assets for the banks. Again, they earn a margin on that, and that will help to drive the earnings.
Therefore, so when we saw those bank charts or the stock charts of the banks previously, and you compare with this one, what's the disconnect then?
So we're back to what we had last year, which is they rocketed out at the beginning of the year. There's some pessimism, and we think by summer into fall, that's when the banks will be positive.
Ben, always a pleasure. Thanks so
Thank you.
much. Ben Gossack, he is portfolio manager with TD Asset Management.